Hi, everybody, and welcome to the latest edition of our regular Trivium China markets and econ update. My name's Andrew Polk, here to talk about the latest policy developments in the macro space. As always, joined by our head of markets research, Denny McMahon. Denny, thanks for joining me today.
Pleasure as always, Andrew.
Great. So today we're going to look at the latest policy moves on two particular fronts, which have happened really in the past few weeks. One is in the equities market, as officials have looked to put in some support for the equities market. And over the past few weeks, we'll talk about what they've done, what the kind of goals are, how this compares to previous rounds of support for equities markets, and then the property market, kind of increased incremental measures to help stabilize property market, particularly on the sales side as well. Obviously, property market's been a big challenge and in the headlines all year. So we'll talk about those. And then actually just to throw a spanner in the works, catch Jenny off guard, we might also talk a little bit at the very end about currency. It strikes me that's the other thing that they've been doing a few things on policy wise. I mean, all of it is about stabilization. It's kind of the key theme looking at all three of these areas. It's not like any of them is going to take off in a extreme positive direction. They want property sales to stabilize, they want equity markets to stabilize, they want currency to stabilize. And so we'll go through the latest moves, what the we think the outcomes will be, what they've been to date, and kind of what the overall policy goals are here. So, Denny, let's go ahead and start with the equity space. So, over the past couple of weeks, there's been quite a few measures thrown at the stock markets by officials in various capacities to stabilize the market and boost it to some extent. What's going on? What are the measures that we need to know about?
Okay, so it all started on August 18 with an interview posted on the CSRC's website with an anonymous official who effectively just laid out all these measures or areas of reform that the regulator was kind of looking at. And then the following week, they started putting meat on the bones and rolling out specific measures. So the sort of stuff we're talking about broadly kind of falls into two categories. Technical measures that reduce the cost or improve the ease of trading A shares. And the other is kind of creating new demand for A shares. So to kind of go through those categories, in the first category, we had things whereby exchanges cut transaction fees. You had the Ministry of Finance cut stamp duty from 0.1% to 0.05%. The CSRC reduced margin requirements, all kind of measures that reduce the cost of trading A shares. On the other side of the equation, you had efforts to kind of either generate more purchases of A shares or to prevent the sale of A shares. And so we had things like the CSRC saying that it would slow the approval of new IPOs, effectively ensure that there wasn't an increasing supply of shares in the market, that they started pushing listed companies to buy back shares. They then pushed mutual funds to buy more than they sell. And they introduced certain restrictions on controlling shareholders from selling shares in listed companies that they controlled under various circumstances. And that was kind of like this initial wave of measures to kind of bolster demand for A shares and to kind of try and inject some sort of confidence in the market. So that's what we've seen so far.
Thanks. That's a great wrap up. I believe I don't think you mentioned they also asked some number of fund managers to purchase shares in their own funds as well, right?
That's
So
right.
also
That's right.
another move. These are all kind of, they're not this is different than some of the intervention we've seen in the past. This is not the national team, right? The national team is when you have big state-owned financial institutions, whether they be insurance companies, the banks themselves, other funds, who are told in no uncertain terms by Beijing start buying in the market, right? This is not that. It's much more, nuanced. It's but still the signal is, these signals in the Chinese systems are quite clear to key players that hey, it's time to do your bit to help support the market. So what do you think is really going on here? I know that we saw a piece in the Economic Daily that you flagged from a couple of weeks ago that really kind of crystallized for you, like, hey, they're stepping in. So walk us through that article, and then tell us, what's fundamentally at play here.
Yeah, right. Well, in some ways, in hindsight, I mean, hindsight is 2020. Beijing started flagging this at the July 24 Politburo meeting on the
Oh,
economy.
that's right.
There was this line that the authorities wanted to enliven capital markets and boost investor confidence. Now, at the time, it was difficult to be entirely clear what that actually meant. Did this mean that they were going to deploy measures to boost the stock market? It wasn't really clear. In hindsight, clearly that's what they had in mind. But then on the 3rd of August, there was an article in the Economic Daily, sort of a party mouthpiece for, on economic issues, in which it was, in no uncertain terms, was talking about the importance of capital markets. Specifically, it called for a slow bull market. Now, that expression has been around for a long time, but it's not something we've heard much about recent times. It was kind of interesting to see it in the Economic Daily, and it was talking about, broadly speaking, about how important the capital markets are in this point in time, in the context of boosting as a reservoir for citizen wealth. And it said that it was kind of, an important tool for stimulating demand and consumption. This kind of ties very much into the sort of the concepts of common prosperity, which is like, back a few years ago, authorities were quite clear that, a more vibrant, capital market, stock market was an important way for the public to benefit from common prosperity, whether it be through dividends or rising stock prices, whatnot. And so, beginning of August, the Econ Daily was kind of talking in these terms, and we were like, "Oh, that's interesting." It kind of seemed premature to kind of say categorically that Beijing was like, "Right, we want to turn around the stock market," but it was pretty clearly in hindsight that the first sort of signal of this. Now, what we've been trying to work out is that, like, clearly this is not the first time that Beijing has intervened to turn around the stock market. Now, in the past, its interventions have kind of fallen into two buckets. One, they are very clearly concerned and even disturbed by falling prices. And so they intervene hard and aggressively to kind of put a floor under the market. And that's when typically they mobilize the national team. They get the big guns out. They start, buying stocks to ensure that the market doesn't fall any further. Then there's kind of been another category, and we saw it probably most clearly in 2005. We saw it again in 2015, where Beijing just wants prices to rise. It's much more emphatically about stimulating a bull market as opposed to a response to any concern about falling prices. And in those instances, particularly, I mean, it was most clear in 2005, the message from Beijing, somebody, whether it be an unnamed regulator or it's a government publication, says something along the lines of, stocks are undervalued. And then everybody, the entire public, knows exactly what that means and sort of piles on into the market. What we're seeing this time around is a little bit different, because we're not getting that clear, it's time for the retail, investors to kind of, get back in because the only way is up, baby. And at the same time, the market hasn't been doing so badly. It hasn't been a great year. Certainly, it hasn't been great since the bounce, the post-COVID opening bounce. Last few months haven't been great, but you still haven't kind of seen this precipitous drop. There's nothing to kind of suggest that Beijing is in panic mode. So we're kind of in almost new territory. It's like, what does Beijing want to achieve by kind of signaling, by sort of boosting the market at this point in time? And I think there's a number of reasons for it. The first is kind of ties into this idea of domestic demand and consumption, because the place that the Chinese public have most of their savings is in property. And clearly, their sense of household wealth has taken a huge hit over the past couple of years, but the past year in particular, because of what's happening in the property market. Now, under those circumstances, this is an ideal moment. This would be, this would, under those circumstances, it would be fantastic if equity markets were rising, because at least that would give the public at least some sense of the potential that their savings could actually earn anything, given that the property market's in the doldrum. Now, tied into that is Beijing has a very clear vision of the role that capital markets can and should play in sort of this technological revolution that they see in the economy. That this play to make China technologically self-sufficient, this vision of the economy being driven by technological innovation, is tied intrinsically with being able to harness capital markets to be able to fund that. For that to work, you kind of need rising capital markets, so that it attracts the capital necessary to be able to invest in innovative firms. And I think the third thing to keep in mind here as well is that one of the reasons Beijing has been so reluctant to cut interest rates is because it is wary of seeing that interest rate differential between the US and China get any bigger because of the additional pressure that will put the renminbi under. Now, if A shares start rising again, then presumably that will mean greater inflows of capital from overseas into the A share market, and that will lessen any future pressure on the renminbi. So there's a bunch of kind of political reasons for why at this point in time Beijing would like to see much stronger A share prices, and it's kind of very different from the driving motivations for interventions in the past. Now, that said, they're using all the same old tools that we've seen in the past. Cutting stamp duty, changing margin requirements, slowing the pace of IPOs. I mean, some of this stuff, putting pressure on certain institutions to buy shares. It's the same old playbook. The question is whether it will be as successful this time around as it was in the past.
Yeah, I'm fully, aligned with you on the view here. And I think I really want to kind of highlight that term, that slow bull market term. I remember that very clearly being trotted out. As you say, it's been around for a long time, 20 years, but I remember it being in particularly trotted out in late 2016 and into 2017 as so. Just a quick history lesson for many of our listeners and watchers will remember this, but a lot of economic volatility in China in 2015 and 2016 that really started with in late 2014 massive run up in the stock market. And this is when they were saying all systems go, national team get in. They had deflation. They were trying to just pump up confidence, and the stock market basically doubled in 6 months. It was one of those where living in Beijing at the time, every cab you were in, at every red light, the cab driver was checking his stocks to see how rich he was getting minute by minute, second by second. Then, of course, that ended in tears. And when they tried to slow the rise of the market, they raised margin requirements. They slowed the ability to borrow to buy stocks, and then the market just fell off a cliff and cratered again by like 50 or 60% in the course of a month or two. That then was followed by the mini adjustment in the currency by the PBOC of August that year, capital outflows, just absolute economic volatility in 2015, and a lot of it was really kind of kicked off by what was happening in the equity markets. So you fast forward to late 2016 and 2017, they've instituted some new policies, supply side structural reform. They're trying to imbue some more confidence in the economy and the markets. And they really were emphasizing every day, we're looking for a slow bull market, or we're looking for a slow bull market. And at that time, and I think there's remnants of that now, the emphasis was on slow. They were like, we want the market up, but we don't want a replay of that mess that we had just a couple of years ago. And so, that was really the signaling mechanism was we're offering support to the market, but we are really trying not to overdo it. And so, that's an important part of the signal. And I think, that's something that investors definitely need to keep in mind. But, anyone who's looking at this is that officials, maybe they will still overdo it and we'll get a crazy bull market, but they are trying to be as, as nuanced and kind of agile here as possible. And I think that again is why you're seeing that term slow bull market. Last thing I'll say on that is, it does kind of make me laugh because of course a slow bull market is what every policymaker would want. We generally want prices rising, but not too quickly to cause financial instability. Well, yeah, no crap. I mean, that's what everybody wants. So I always kind of laugh when I see that, but I think the signal that it's sending is quite clear. So, with that, Denny, what do we expect next? I mean, we've seen, right, the stock market's up, what, 3% ish from when they've started putting these measures out. So it looks like we have basically stabilized. What do we expect next on the policy front for the equities market?
I think it's probably, yeah. So the CSRC, when they put out that anonymous, interview, 3 weeks ago, they had a whole list of stuff that they were considering. I think gradually we'll just kind of move through. It's all kind of mainly technical adjustments. I think they'll kind of dig into that. The big thing is whether they will deploy the national team or whether they will tell Hui Jin or CIC or whatever well, not so CIC, but Hui Jin to buy bank stocks, or whether they will mobilize a large amount of state resources to start buying A shares. And I don't think that's usually crisis mode, and I don't think that's the problem that they're dealing with here. What they really want is just prices rising slowly. So I think the real thing to watch is whether this kind of bounce that we've had over the last few weeks, which is clearly a response to the measures Beijing has rolled out, what happens? Does that flatline? Does it keep continuing to inch upwards, or does it correct downwards again? And I think that will pretty much determine what Beijing's response is. If things keep inching up again slowly, I don't think regulators will feel compelled to do more. If they flatline a little bit, then we'll see more measures in an effort to kind of push things up. But if things fall, if the market turns around and goes, not good enough, not enough, what else have you got? Then we'll see. We might see, these more measures. We might see the measures that we've already seen ramped up. But I think ultimately, if prices fall, then we'll get just more of the same in terms of technical adjustments and the sort of things. They might not be exactly the same measures, but they'll broadly fall into the same sort of baskets.
Yeah, I think that's a good point, and I agree. I think the key that you said to me is that policymakers are not in crisis mode here. I know there's obviously a lot of negative sentiment towards the Chinese economy, towards Chinese assets, a lot of commentary out there, peak China, this and that. I mean, that's probably diving into all of that's probably for another session. So we won't get into it now, but I think we do both have thoughts on it. But point is, national team bringing in the big guns, that is panic territory, and that is when we're cratering 30% in the stock market in a fairly short period. Stocks are off about the CSI 300 is off about 12% since the peak in late January after the reflation trade. So this isn't a total dive, but officials do kind of want to stabilize things again. And my view would be that a lot of this, and you see this in various areas, is about confidence. I think officials know they have a confidence issue in their economy. And it's very hard when you've got an ailing property market, stock prices falling, currency falling, you see manufacturing slowing, the latest PMIs in the service sector, lowest in 8 months. Like it's hard to jump from that into a virtuous cycle. And so they're looking for areas where they can provide some sort of boost to confidence. And it's not like the stock market going up 3% or 5% or even 7% is going to change the game or the economic reality or the financial reality of households. But if you can do that in a few areas, stabilize housing prices, push stock prices up a bit, you start the first baby steps in kind of stabilizing confidence and potentially even boosting it. So this is all to say, like, we're not in crisis mode. They're not going all in. They're doing technical adjustments. And so far, it seems to be kind of achieving their goals. We'll see if they do more throughout, the months ahead. I mean, my guess would be that they will continue incrementally changing things to see if they can get a slow shift in confidence towards a more positive area. So speaking of areas where they're making incremental adjustments, we also have seen quite a bit of action in the property market over the past few weeks. Specifically, some measures to around mortgages, mortgage down payments, and interest rates on mortgages. Jenny, why don't you walk us through the latest developments that have happened in that space?
Yeah, so there's primarily three main changes that have come from Beijing. The first is that they have cut minimum down payment requirements. Now for first time home buyers, the more down payments 20%. Previously in second tier cities, it was probably around 30%. And for for your second property, this is your second mortgage, then the down payment's 30%. Now in second tier cities, it was broadly in the range of like 40 to 50% and significantly higher in first tier cities. Now, this sort of change isn't obligatory, so chances are in places like Shanghai or certainly some districts of Shanghai that it might not be reduced. But you'd probably expect it to be applied fairly broadly, certainly through second tier, third tier, fourth tier cities. The second significant change was, this movement. So traditionally, people who had previously had a mortgage but didn't have one anymore, and they went to get a mortgage from a bank, well, the bank would treat them as, well, this is your second mortgage. And so they wouldn't be entitled to lower down payments. They would be, forced to pay that higher down payment. So if they're in a second tier city, they might be paying a 50% down payment as opposed to a 30% down payment, because even though they will only have one mortgage, the bank was treating them as kind of being an investor as opposed to an owner occupier. So Beijing got rid of that requirement. The cities have discretion as to whether they apply that change or not. But the idea is that now there's a whole lot of people out there in China who will be able to take out a mortgage and will have lower down payment requirements and lower other restrictions as well, and that will sort of create some additional demand. And the third significant change is something that the PBOC has actually been flagging for the last couple of months, but we're kind of getting closer to it actually being implemented, is that the PBOC wants banks to lower the interest rate on the existing stock of mortgages. So, the minimum mortgage interest rate has come down significantly over the last couple of years. Now, in theory, because of almost all mortgages in China are adjustable rate, in theory, the existing mortgage holders should have benefited every time that the mortgage rate came down, every time that the loan prime rate was reduced. However, for various reasons, those interest rate cuts aren't always passed on in their entirety to existing mortgage holders. What the PBOC wants is that for the public, those people who already have a mortgage, but their mortgage rate is significantly higher than the minimum mortgage rate in their city, that they are allowed to renegotiate their contracts or to get a new loan from banks that allow them to reduce their mortgage rate significantly. So those are the three big changes. Now, the interesting thing about that third one is that's not really going to do anything to stimulate the housing market. First and foremost, that is an effort to boost potential consumption, because what that's about is about reducing the monthly payment of existing mortgage holders such that more money gets put back into their pockets. Hopefully, then they will spend that money and that will boost consumption. We've written about this a little bit before in the past. Chinese mortgage holders traditionally are inclined to say, whenever there is a saving they experience savings on their monthly mortgage payments because interest rates have come down, they typically save most of those savings rather than spend it. So it does remain to be seen, these changes, whether they will flow through into a meaningful boost of consumption or not. The other big issue here as well is that even though the PBOC is telling banks to do it, the banks aren't enthusiastic. I mean, the banks see mortgages as the single best quality and really the best earners that they have. Something that kind of differs in China from often the rest of the world is that the interest rate that banks earn on mortgages is higher than the interest rate that they earn on most corporate loans. Why? Because most of the corporate borrowers in China are state-owned. So the banks love mortgages because they're perceived as being safe, because they're backed by collateral, and because they have a relatively high interest rate relative to sort of other assets. Now the PBOC is telling banks to further erode the profit that they can make from this sort of asset, this particular asset. It'll be interesting to see the degree to which banks kind of get on board and pass on those interest rate reductions. And secondly, they might just drag their feet. Anyone who's gone through a mortgage refinancing experience in the United States knows how much of a pain in the ass it can be. And it is conceivable that maybe the Chinese banks will make it difficult as well. Anyway, these are all open questions at the moment, but the point to make is that this isn't an effort to boost or reinvigorate the property market. This is about consumption. Those other two measures, the first one about cutting down payments and allowing people who've previously had a mortgage to be treated as first-time mortgage borrowers. The significance of these measures is ultimately about trying to create a bigger pool of potential home buyers, right? So it's assuming that there's kind of a bunch of latent demand out there, people who want to buy homes, but because of the restrictions that have been imposed on them, they're not buying. If only we can open the pool up a little bit, that will create more demand. And it probably will. There will be an incremental increase in demand from these changes. We'd be surprised if it's certainly a game changer or certainly enough to breathe life into the market. I think what really needs to happen in China is that for prices to fall. I mean, that's kind of what happens everywhere else. The market readjusts when prices fall sufficiently. But of course, in China, the main market isn't the existing housing stock. It is the main market in China is newly constructed housing, and there are political limits on how much a developer can reduce their prices. I mean, local governments are typically very strict about telling developers that, once you've started selling, accommodation in a housing project, after you've already started selling, you can't reduce prices more than 10%. And one of the reasons is because they're worried about social instability, because if you've already bought a house in a development, all of a sudden, your neighbor managed to get it 10% cheaper. It's people get upset about that sort of stuff pretty quickly in China. And of course, then there's also ramifications for what it means for future land sales as well, which is important to local government revenue. So the changes are interesting. Particularly the one that'll affect consumption. It'll be interesting to see how that plays out. But the other two, all they're really doing is they're potentially creating an incrementally bigger pool of potential buyers. But none of this is, despite sort of all the optimism and enthusiasm that's kind of been expressed in the press, these aren't game changers, and they're not really likely to move the needle in a particularly significant way.
Yeah, it strikes me that in a way, I mean, they're obviously different realms and kind of different aims, but in a way, it is analogous to what's happening in the equities market. Just some little technical tweaks to try to get some stabilization, not a big, bazooka, not a real game changer. Do you think that we are on the cusp of stabilization finally in China's property market in terms of sales, or are we still a ways off?
No, I think we're a ways off. And I think there's a few issues here. I mean, the first is the big issue at the moment is that developers need to sell their existing stock of housing. So, or the stuff that they didn't manage to sell in pre-sales, they've got to sell now. They finish a development, they've got to sell now. Or they've got developments that they haven't finished, but there's a whole lot of units that they still need to sell. They need the liquidity, so they still need to sell it as pre-sales. And if prices aren't falling, it's difficult for people to kind of really have an incentive to go in and buy it. I mean, anyone in China can look at what's happening in the secondary market where there's a whole lot of stock, prices are falling, people keep cutting their prices to try and move secondary units. You just have to look at that. And then you look at the primary market, and it's like, well, if I can't buy at steeper discounts, then, why should I buy? And then, of course, there's still the perennial problem of pre-sales as well. Why buy something that you are not going to receive for another year or 2 years when that sort of model of selling houses only really works when the buyers expect prices to rise and rise sufficiently to make a major outlay for 2 years, to have a mortgage for 2 years, paying interest payments for 2 years without actually owning the asset. So yeah, I can't quite see the breakthrough coming anytime, in the near future.
Well, that's not good news for the trajectory of the Chinese economy, but we'll continue looking at this issue. I think there will be more, incremental moves coming. My personal view is that basically policymakers, certainly a lot of the weakness in the property market is not intended, but policymakers have just decided it's time to swallow the bitter pill of adjusting the property markets, outsized role in the economy. And that's going to have massive knock-on effects to many different parts of the economy and both in China and the global economy. So this is a long-term story. And I think this is kind of where, some of the bigger stories around, overall China's economic trajectory has downshifted are right because the property market was a big driver of that. I think it's still an open question as to how healthy that growth will be going forward. But I mean, I've been doing this for 20 years and have always said a lower growth rate for China is a healthier growth rate. You can't keep growing at these rates in this method through investment, particularly in infrastructure and property, forever. I mean, it's classic economic, development story, especially in terms of like the East Asian model. But we'll see. So we are likely in for some more pain over the coming months, and this is going to be a long-term adjustment. But we'll be following these moves closely. Lastly, just quickly, Denny, I know you've got to go, but so we're trying to stabilize the equity market. We're trying to stabilize the property market, likely to less effect than the moves in the equity market. Also trying to stabilize the currency, it seems. So, dollar's been on a tear since mid-July. Generally, emerging market currencies in particular have been hammered. China has not, been an exception to that. Currency trading against the dollar at 15-year lows. I'll dive in here. They've just done a couple of things. Again, very similar kind of story. So this is the theme, just little technical tweaks to start to change the story a little bit. So they've been asking banks to intervene a little bit more aggressively. The most recent move is lowering the FX reserve requirements that banks have, so that lowers their demand for dollars by a touch. Increases their ability to buy the CNY, sell dollars. Again, not a game changer and doesn't really change the path of the dollar. So it's not like we're expecting the CNY depreciation to stop on a dime and start moving in the opposite direction, particularly if the dollar continues to strength. But they are hoping that it does take a little bit of steam out of renminbi depreciation and potentially, hopefully, soon lead to more stability in the exchange rate. And so, same kind of theme: technical tweaks to get us to try to like stem the bleeding, imbue some confidence, and stabilize asset prices. Any thoughts on the currency side, Denny, before we wrap up?
No, I think that sums up pretty well. It's been interesting. I mean, looking at PBOC and safe pronouncements this year, one of the things they keep falling back on is like the Fed will stop cutting rates at some point. Sorry, the Fed will stop hiking rates at some point. And they're like, that'll happen, and then everything will be cool. And
Yeah.
so I think to a certain extent, they're kind of hanging on for that and the expectation that it has to happen eventually, as they'll do what they can with these sorts of tweakings to kind of limit the fallout until then. But it is going to happen, and then everything will be cool. But anyway, that's the line they've been selling for a while now.
Yeah, it's remarkable, that the way intervention has changed by the PBOC. They really, I mean, since 2016 have, you know, changed their mindset and let the currency go through, fairly significant bouts of weakness over short periods of time. Their mantra used to be, and I think they don't say that as this as much, but I think it's still very much part of the mentality, is the PBOC is supposed to be a counterweight to the market, supposed to keep, basically, especially a counterweight to speculation. They don't really care about currency weakness so much. They care about it, but what they really care about is speculative currency weakness, piling on, short sellers piling on to short the currency. And similarly, in times of CNY strength, hot money inflows that push the currency up farther than they'd like too quickly. And so they're always kind of trying to play a counterbalance to keep the moves, to keep the currency from becoming a one-way bet either way, and to keep appreciation or depreciation from happening just too quickly and too intensely over a short period of time. And so these moves are kind of just technical tweaks to offset some of that pressure. I think I'll wrap up by saying, I to me, like I said, that's a theme. We're seeing technical moves. Maybe they should be, but officials are not panicking in any realm on the economy right now. They see the challenges and they are trying to do tweaks. We've talked a lot about the one big thing they don't seem to have an answer for is consumption. So, that one still is a little bit of a mystery. But otherwise, they're turning the dials in a more nuanced way than we've often seen. And it'll be interesting to see, if we get some stability, even a slight bit of stability in home sales, if they start to deteriorate less fast, at least, if the currency stabilizes as the Fed tails off on its hiking, path, and equities start to look better, maybe you start to have a changing narrative in terms of how investors are thinking about the Chinese market. We're not there yet, but open to the possibility. So for once, maybe we'll leave it on an optimistic note, unless you want to bring everybody down before we log off, Denny.
No, I'll keep my mouth shut.
Okay. All right. Thanks for the time. Good to see you. Thanks everybody for watching, and we'll be back soon. Bye bye.